Hello, everyone, and welcome to our financial webcast presented by Legend Financial Advisors. Today's webcast is entitled From Headlines to Perspective, Making Sense of Market Volatility. I want to thank you for joining us today, and my name is Dan, the moderator for the webcast. Today's webcast presenters are Jim Holtzman, CEO and President, and Bill Knight, Wealth Advisor at Legend Financial Advisors. Please hold as I turn the broadcast over to Jim and Bill.
Okay, thank you everyone for joining us today. There certainly has been a lot going on in the markets and geopolitically speaking. And part of the goal of this webcast is to give some information regarding the current events, drawing them relative to what has occurred previously. And you can see this slide that we have up right now is for oil prices and markets. And we'll talk a little bit historically about prior oil crises that have occurred. So let's jump into this slide and take a look at where we are today. So right now we have the Iran 2026 war, and you can see that at the very far right of the screen. But historically, and this chart goes back to 1970, you can see there have been a number of different panics that have occurred. And if we go back to the very beginning of the slide, you can see the one that probably gets talked about the most was in 1973, the Arab oil embargo. And you can see the spike that occurred in terms of the price of oil relative to where we were at the beginning of that cycle. You can also see once we kind of hit the peak of that period, you can see oil prices came back down. And then we kind of run our way through the next crisis as far as spikes go, and that was in 1978 with the Iranian Revolution. And just kind of working our way through the chart, we had another crisis in 1980, the Iran-Iraq War. And then one thing you'll notice, though, in between these periods, that the price of oil does continue to run up. So we go to the first Gulf War is the next period, 1990. And just giving you some perspective of the different periods. We're not going to dive into each one of these. Then you can see September 11th, 2001. We had the second Gulf War that followed not long thereafter. And I'm not going to read through every one of these, but just giving you that perspective that every handful of years there is a crisis that has more of a direct impact of the oil market. So I think one of the big issues is that when headlines start to jump up regarding this, it's very noticeable for everybody, especially because oftentimes this will impact how much we're paying for gas at the gas station. And that hits everybody really on a day-to-day basis. So certainly that is what is occurring right now, as we've seen a big jump in the price of gas whenever we hit the gas station. And oftentimes, what I think part of the issue with oil price shocks, if you will, is that they occur very quickly. And the markets, in terms of the price of oil, reacts very quickly. And oftentimes it's usually because of geopolitical events. There's a lot of headlines, and that creates a lot of concern about what may happen going forward for the economy and also for the markets. And I think, part of this, as we've seen this in the past, is that the price of oil has such a big impact. It's not just what we pay at the gas station. It's also, there's been a lot of talk about the cost of fertilizer and the impact that it has. And you could just go on and on down the road because there are different products, delivery costs rise, and there's an impact on inflation that just trickles through. And we'll talk a little bit more about inflation later. But I think part of this, when you look at the slide, is that it's not unusual to have these spikes when these geopolitical events occur. We've already seen the price of oil jump quite a bit in the month of March, and then we've also seen it drop quite a bit. And then another subsequent rise has occurred in the price of oil. So it's very volatile. It can change very quickly. However, once the price of oil starts to maybe settle in more and fall off from its current peak, you're going to have a trickle down, though. That's going to take a while to flow through the economy. And there's always going to be kind of a timing impact and a delay for how long it takes for the price increases that have occurred to flow through. Also, with the Strait of Hormuz, in terms of the blockades and not letting oil through, or less than there was, it's not like you just turn on a light switch and everything is back to normal the next day. It takes time for the kind of the normal regular flow to get back to normal, and therefore it'll take time for the prices to get back to normal. So it's just unfortunately not like a light switch, and it doesn't happen very quickly once these events start to occur. But I think, as you can see throughout time, is that it's very volatile. We've been through these stages before, and they're not pleasant because of the impact to us on a day-to-day basis. The oil prices are really probably one of the bigger attention grabbers at this point in time. From our view, we still have to keep a longer term perspective on how we're managing the portfolios and understanding the impact it will have to the economy. With that, we'll go to the next slide.
So with this next part, we want to talk a little bit about the movement in markets and put that into perspective for everyone. As Jim mentioned, a lot of the headlines can almost be fear-inducing in a sense where it can cause tension, create a lot of doubt. And what we want to show is what has actually occurred in the market over the start of this year, and then provide some perspective in terms of what having alternative types of investments can help with when it comes to having a diversified portfolio. So with this chart that we prepared from Y charts, this shows the most common market indices that if you turn on the news or if you go to a website such as the Wall Street Journal, these are the most common indices that you will find commonly quoted. And so I'm going to go through those and look at the performance. So this chart in particular, it goes from December 31st of 2025 through April 10th. So that is last Friday. And the market indices that are include the S&P 500. So that is in purple with a return of through Friday down 0.07%. The S&P 500 is a large cap index. It's a blend of both growth and value. From there, we have the NASDAQ composite total return. That was down 1.29%. The NASDAQ is more technology heavy. It's seen as a large cap growth index, and there's also some retail names in that index. From there, we have the Russell 2000. So that's showing the returns of 2,000 small cap companies that are a blend of value and growth. So it's actually been the top performer over this time frame, being up 6.33%. From there, we have an index for how the overall bond market has performed. So we use the core US aggregate bond ETF to show that return. That's the green line here, being positive 0.42%. And lastly, we have the Dow Jones, which is seen as a representation of blue chip companies, about just over 30 of those, and the return was 0.01%. But overall, you can kind of see the volatility, a strong start to the year for several of the indices. And then as we've come into the March timeframe, you saw a lot of that drop, associated with a lot of the volatility that has occurred. And since then, we've seen a rebound in the markets. Now, on the next slide, I want to highlight some of those same index returns, but also show some of the asset classes that have actually performed really well over the same time frame. So the important part that we talk about is having a properly diversified portfolio. So that's going to include different types of investments that can perform well even when the market as a whole may not be performing well. And so some of those investments that are included here, those will include exposure to commodities. Now, this is the same time frame. This is from December 31st through April 10th of this year. And the investments that were added to this chart include exposure to a broad basket of commodities that is represented by this green line. So this investment in particular has exposure to commodities such as gold bullion, so physical gold, commodities such as oil, natural gas, copper, corn, and soybeans, among others. And you can see that over this time frame, commodities is actually one of the asset classes that has benefited during the kind of the changing supply and demand fundamentals that we've seen as a result of the war in Iran. So this is one investment that can really help during volatile time frames. It's also not necessarily dependent on having a really positive market for it to be able to do well. So it acts as a very nice diversifier. In addition to that, we have the iShares Gold Trust in here, which is physical gold bullion. That is up 10.34% over this time frame. We can see initially in January of this year had a nice spike up, and then it retraced a little bit, but overall has performed well, relatively speaking. Gold in particular performed very well last year, and it's been a nice diversifier, and it's seen as a one of the investments that will act as a nice hedge and more of a source of safety in times like this. In addition to that, one of the other funds, and actually the top performing fund that we've had for clients or some clients, is the energy fund, and this is a broad basket of energy companies. It could be companies such as ExxonMobil, it could be Chevron, and that's also benefited just given the energy crisis, and that's been up over 28% over this time frame. So one of the items that most people don't realize is that even though there's been volatility associated with this time frame, a lot of volatility towards the downside, is that there are still different asset classes that are performing very well during this time frame, and it really makes a point for having a well diversified portfolio.
Okay, so now we're going to talk about inflation pressures that we have seen, how interest rates respond to them, and then there's also been a subsequent impact on the housing market because of mortgage rates going up. So the first thing we'll talk about is where the inflation rate is. And so in this particular chart, we're running this about a 10-year period, and kind of meant to give a little bit of perspective on where we've been. And you can see heading into 2020, right when COVID started, we had mortgage rates or inflation rates, I'm sorry, at about 2.5% at that point. And then you can see it just dropped like a rock when the economy had to come to a halt at that period. And basically inflation went down to almost zero at this point. And then as the economy started to open back up, inflation started to come back. And at that period of time, there was a lot of stimulus that was happening in the U.S. economy, and that caused inflation to really jump for a period of time. And you can see there was a peak in 2022 where it reached around 9%. Thankfully, that was relatively short-lived, and that inflation rate started to fall back down as we headed into the rest of 2022 and then heading into 2023. Then you can see inflation from that period has been pretty choppy, but overall was starting to trend lower. And then we head into 2026, where inflation was a little under 2.5%, but then we've now seen a spike up to currently around 3.3%. And that pretty much has occurred over the period of the end of February, beginning of March through now. So it gives you an idea of where inflation has been. Historically, we're kind of above average, or at least historically based on this particular time frame. Much lower than we were whenever we were coming out of COVID, but certainly higher than we've seen over the last, going on really about a 2-year period at this point in time. So now the next slide is going to talk about interest rates a little more specifically. So this particular chart is reflecting what is called the federal funds rate lower limit. And it's a fancy name for whenever the Federal Reserve meets and they talk about interest rate movements. This is what they are really talking about. So there's a lower limit, there's an upper limit. I went with the lower limit because that more reflects where we are today in terms of interest rates as it's reflected on maybe a money market fund, for example. So again, this chart runs back about 10 years just to give some perspective about where we have been. And you can see at the very beginning in 2016, we were still really floating right around zero at that point in time. Then we started to increase, and I say we, meaning the Federal Reserve started to increase interest rates. And you can see there was kind of a temporary peak in 2019, and it kind of flatlined for a period of time. Then interest rates were starting to come back down by the Federal Reserve. And then you can see once COVID started, it just dropped like a rock. They basically reduced interest rates down to zero, where we stayed at that point all the way into 2022. And then we started the rise of the federal funds rate. When the Federal Reserve would meet, they pretty much were increasing rates at every meeting. And that was to battle the inflation that I shared on the prior slide. And then you can see that kind of leveled off in 2023, heading into 2024. And then there was a period of time where the Federal Reserve started to lower interest rates. The idea on that would be they felt inflation was more contained, try to stimulate the economy a little bit more. And you can see there's been a kind of a subsequent, almost like a step down in terms of rates. And currently we're at 3.5%. And that's about where money market rates are. You should at least be getting somewhere close to that for money market fund rates. So we've kind of flatlined at this point, at least for the time being. With the rise in inflation, there's been a little more talk, and I don't think this is going to happen, about whether the Federal Reserve would actually increase rates again to help temper inflation. I think they're taking more of a wait and see approach with what is occurring right now in the Middle East, the price of oil, and probably leaving things be, and then probably not reducing rates over the next meeting or two. But that all remains to be determined. But it gives you a little bit of an idea of where we have been, and where things how we've gotten there. So on the next slide, we'll talk about the 30-year mortgage rate. And this has a little more impact in terms of headlines. And again, 10-year chart, kind of giving you an idea of where we have been. At the beginning of this particular period, we were in the high threes for the 30-year mortgage rate. And then you can see there was, for the most part, a steady increase heading into 2019. Mortgage rates were at that point close to 5%. And then you started to see a slowdown in terms of the mortgage rates, and rates steadily dropped off. We hit COVID in the 2020, and long-term rates came down, and mortgage rates came down with it. So you got to a low point, which is kind of hard to believe, where if you got in right at the very trough, if you will, of the 30-year mortgage rate cycle, you had mortgage rates 30 years around maybe 2.875% if you were lucky enough to time it perfectly. It just gives you an idea of how the impact of inflation, what it had on the 30-year mortgage rate, and really hit all-time lows at that point in time. Then from that point going forward, rates started to climb back up. We hit that 2022 period where we were talking about inflation being around 9% at the peak, and you can see the 30-year mortgage rate went up with that. Its high point, you can see, would have been late in like 2023. Mortgage rate was close to 8% temporarily, and then it dropped pretty quickly when it got to that point. And then you can just see how choppy it has been, but overall was trending down as we headed into 2025. And then it started to spike up again. And oftentimes mortgage rates are really a reflection of the market's expectation for inflation. So if the market is expecting inflation to be higher, long-term interest rates usually rise with that, and the 30-year mortgage rate will kind of follow in suit with it. And so most importantly, where we are today, right now, the 30-year mortgage rate's about 6.37%. And you can see that spike that has occurred so far in 2026. It's come down a little bit off the highs of recent, but you still see the overall trend has been sharply higher this year. The other part of this that has an impact from an investing standpoint on the bond market, generally speaking, when long-term rates go up, traditional bonds will fall in price. And as a result, the bond market has struggled more this year as a result of that. The bond market got off to a pretty good start this year, but then those gains kind of evaporated with the rise in long-term rates, and as you can see subsequently with the 30-year mortgage rate. And then on the next slide, kind of that ultimate consequence is on U.S. existing home sales. Again, 10-year period we're looking at, you can see at the very beginning, relatively, it's always going to be volatile based on what is happening. And then you see the U.S. existing home sales start to fall off as we head into 2019, and they start to rebound, and then you have the big COVID drop, not surprisingly at that point, because just nothing was moving, economically speaking, and certainly the housing market. And then you can see as long-term rates, as we're looking at on the 30-year mortgage rate, were starting to fall in that period. You then can see the U.S. existing home sales start to really spike in that period. A lot of pent-up demand. The market had basically frozen at that point, and you can see how sharply it rose. Then it fell off from kind of a pretty quick rebound to still really good levels in terms of existing home sales. Then had kind of a temporary spike as we started off into 2022. And because of where the housing market and the economy was going in 22, you can see those existing home sales fell off. Part of that is because, as we looked in that prior slide on the mortgage rates were starting to run up again. So existing home sales took a hit with that. Then it's kind of been in a range from that point until going into 2026. And I think most importantly, just looking at the very recent trend, you can see U.S. existing home sales have fallen off from even the start of 2026. It's fallen off quite a bit. Again, a reflection of where mortgage rates are, a lot of uncertainty created by that, and U.S. existing home sales also reflect that.
Okay. For this next part, we want to discuss a little bit in terms of how we can shift from some of the emotional impact that we see in the headlines to really what is the opportunity set that is present when it comes to managing portfolios. So with this next slide, we have the same visual that we went through on a previous slide, showing what some of the common market indexes are here. So this is showing what has occurred so far from the end of last year to Friday, April 10th of this year. We have the common market indexes here. And this is kind of showing some of the opportunities that we have found with some of our clients' portfolios over the course of this year so far. And what we do over the course of the year is we take part in opportunistic rebalancing. So you may have some investment managers that might rebalance portfolios or positions within the portfolios on an annual or semi-annual basis. For us, we actually review the investments and monitor them for how they're performing. And if they are exceeding what their thresholds are, we may have an opportunity to either buy more of an investment or sell back part of an investment. So the idea is to be able to make purchases when the price of an investment is low and make a sale when the price is high. And for that in particular, we found two opportunities in particular this year when looking at a few of these investments, and might have an opportunity for a third. So with this graph, it shows two different dates in which we actually moved forward with some rebalancing in our client portfolios. So with this, the first one that occurred in the month of March was actually for gold bullion. And this occurred not only this year, but also last year. It was a similar story for technology over the past few years. But since it's continued its positive performance, we actually received indications around this time frame that gold was exceeding the target position by about 20% or more from what our intentions were. So for us, that triggers an opportune time for some rebalancing. And in hindsight, that ended up working really well just because we were able to make some sales at a more favorable price in gold. And then there was actually a subsequent fall in the value of gold. For us, it gives us the ability to take some profits off the table and re-diversify those into other areas that may have more attractive valuations or just might be undervalued at that point in time. Another one of those examples also occurred for some of our portfolios that held the energy fund, which is this exchange traded fund that holds a broad basket of energy companies. And given the performance, and this was really a result of the situation in Iran and how the supply and demand fundamentals were affecting a lot of the energy companies. So they were able to profit from that. We saw the price spikes and took the opportunity to take some profits off of that position. Because typically with these geopolitical events, they're not always too long in duration. From a market standpoint, they tend to be more short-lived. The situation when Russia invaded Ukraine was another one of those where it was more of a 1 month situation where you saw most of the market reaction in that time frame. So often it can be a nice opportunity to be able to take advantage of some of those price spikes and some of the funds that are really performing well. So those were two opportunities that we took advantage of for our clients.
Okay, we're going to talk about the long-term focus and kind of how to keep things in perspective for your overall financial plan. And I think what we've seen recently, market volatility, it's always going to be uncomfortable. And this particular period of time is no exception to that. And I think that the main thing we try to keep focus on for our clients is that we don't want it to change the purpose of the plan that's been created. And ultimately, a financial plan and ones we build, it's built with market volatility in mind. We know the markets are going to go through over a long period of time. There will be downturns. There will be market corrections. There will be a bear market or two thrown into the mix, just based on kind of the averages that have occurred over time. And so, whenever we're building a financial plan or looking at a longer term plan, longer term projection, I should say, for our clients, it's part of the reason why we don't become very aggressive in terms of the rates of return that we assume, because we don't know when the downturns are going to occur, but we know they most likely will. So we want to always kind of ground the plan with market volatility, in mind. And I think ultimately, the short-term volatility, which I would look at this currently as, is we don't want that to change the long-term goals. And it's been an odd market. The markets have rebounded very strongly as of late, not quite making back all of the losses, but very close to it. And so that's why we don't want to have the long-term plan be impacted by that. And it's very easy to, follow the headlines, follow the geopolitical situations that are occurring, and follow the markets. And, trying to keep things in perspective, we spend a lot of time talking about risk tolerance with our clients and trying to get a good handle on that so that we can construct portfolios in a meaningful manner, so that kind of the emotions, try to remove them as much as possible from the equation. But we also recognize these are really challenging headlines, challenging times from that perspective as well. And I think, ultimately, keeping discipline and consistency are really important for long-term success. From what Bill was just covering on the prior slide, we've built a lot of disciplines into how we manage the portfolios so that we're able to get those triggers, those alerts saying, hey, this particular position, maybe being gold, has risen above much more than what our I always call them guardrails are and what our targets are. And so it causes us to have that discussion internally, and then we come up with an action plan if we think there's one is needed. I think the main thing, though, is that we're bringing discipline into the approach, and sometimes we can find those opportunities, like Bill was discussing. But I think the main thing is, the idea for what we're bringing to the table is that discipline and the consistency to how we're managing the portfolios. So, ultimately, we want to make sure the financial plan is able to get through these periods of time where the market volatility will increase.
One of the other items we wanted to highlight is the importance of making sure you're taking on the appropriate amount of risk. And this is something that we have a questionnaire that's available on our website. This is something that we go through with our clients initially when there's any type of life changes, and really just for being able to check up on the appropriate level of risk for you. And this is something available at our website. The web address is here. Once you navigate to our website, there's a free one-time services section. And if you click on the risk assessment questionnaire, you can access it for free here. And essentially what it does is it asks you a series of about 12 questions, and it gives you a risk score to identify what your comfort level with risk is. And that can at least start the conversation in terms of identifying what is most appropriate for you relative to what your long-term goals are. Because we know if we can make a good decision in terms of the correct portfolio, that it should lead to less angst and concern when it comes to market events like this. But it's always a good time to reevaluate. And even if you're curious about how your investments are currently invested and whether or not those match what you're comfortable with, this can be a really nice evaluation to be able to go through. So anyone interested in that, we'd be more than happy to help you with. So from there, we'll go with the question and answer portion of the presentation. So feel free to ask any questions that you have, and we will go through those for you.
And while those questions, if there's any coming through, we received a few beforehand that we want to make sure that we address. And the first one was how to handle the best timing for required distributions during a volatile market. And just to take one step back with reference to required distributions, oftentimes they'll be referred to as required minimum distributions. And what those mean in most cases is that when you hit a certain age, the IRS requires you to start taking money out of your traditional retirement accounts. And so right now, once you reach the age of 73, that is the starting point. That will be phasing into age 75. Just to give a little bit of perspective for that. You also may have inherited an IRA that requires you to take a distribution each year. There's a whole host of rules that go behind that, but I just wanted to paint a little bit of a picture of what those refer to. If you are required to take a distribution, you are required to complete that by the end of the calendar year. You can take it early. You can take more than the required minimum distribution. But the main thing is that you need to complete that by the end of the year. And so the tricky part can become if the markets are volatile or if you're concerned about the markets, do you want to take the distribution at a better point in the market cycle versus taking it at a point where the markets are down? And there's a whole host of things to consider with that. If that required distribution is going to be reinvested, so you're not required to spend the money, you're required to get the money out of the retirement account. And in certain situations, the money for our clients may get reinvested into a taxable account. So if that is the case, we'll take advantage of that opportunity of the distribution occurring to kind of rebalance. And so the time out of the market is not going to be very long from that perspective. So that issue gets mitigated somewhat because of that. The potential issues can come if the money is going to be used for spending purposes, which often our clients will do. And so in those cases, a couple of things is that we allow cash to some degree build up in the portfolio. If we know a required minimum distribution is going to be occurring, we would be less rushed, if you will, to reinvest those funds, and because we know they're going to be coming out of the account by the end of the year. And so in those cases, perhaps some of the money is already in cash and before the markets start to fall. That is possible. The other thing is that based upon the diversification we try to bring to our client portfolios, as Bill was outlining on a couple of slides ago, just because the market may be down, the market being defined as, let's say, the S&P 500, there can be other asset classes that are doing well, and it could actually be an opportune time to generate the cash to complete that required distribution. So anytime we have a cash flow need, what we do internally is we do a couple of things. We want to make sure that we take into consideration how the funds are performing in that account that the money needs to come from, and we'll take the best advantage we can at that time. So it's hard to control some of this. I mean, nobody knows where the market's going to be on a month-to-month basis, and even if the market, again, defined by the S&P 500, kind of hits a peak and starts to fall over the last quarter of the year, for example, that doesn't mean that every investment in that account is falling over that period, or maybe it's falling less. So just a couple of, there's no perfect answer on that. But if any of our clients are ever concerned, if they have concerns about where the market's going to be and they want to take their required minimum distribution earlier in the year, we certainly, can accommodate that. And we typically target, if there's no cash flow need, we'll typically target around the end of October to complete that distribution.
One of the next questions that was asked is there any threat to the US dollar devaluation? And that was something that we actually experienced last year. There was the US dollar dropped about 10%, which was a large amount. And that was more so tariff related and related to rate cuts. And what had happened was when there's higher inflation or anticipated higher inflation, which for last year was related to the tariffs, that ultimately would decrease our purchasing power, and that leads to a weakening dollar. And in terms of this year, what we've experienced is we've kind of seen it go both ways, where there have been inflation fears more recently, more so 10 days ago and prior, when the issues in Iran started to occur because of what would happen with the price of oil. And that would be something that, if that was more prolonged, it could lead to higher inflation, and that could weaken the US dollar. So if that were to occur over a longer period of time, there are several different types of investments that you can use, and ones that we've talked about so far on the presentation. One of those is gold, for example, that a weaker dollar will benefit gold. We saw that last year with the price of gold continuing to appreciate. We've seen that also this year. So that's a nice diversifier to have in the portfolio. You can also have more international exposure, whether that's to international companies as a whole or even emerging markets that are a little bit more dependent on local economies to be able to perform well, and not as dependent on the US, for example. So that's actually one area that we've continued to add some additional exposure to this year, as it's one of the areas that has more attractive valuations relative to the domestic markets, and also provides nice diversification benefits.
Okay, another question that came in. is the IEA, which is the International Energy Agency, has called this oil crisis the largest supply disruption in history. How do we plan to adjust a traditional portfolio to avoid the roughly decade plus of losses such a portfolio experienced during the last oil crisis of 1973, 1974? So it's a really good question, and it was from a standpoint of how the markets did over that period, like into the 70s, and really that even kept going into the early 80s. The markets themselves, as I always say, kind of their nominal or their actual return wasn't awful. But what was occurring, as I'm sure everybody remembers, is that inflation really had skyrocketed, probably because of this issue. And the real return, or the return after inflation, was negative. And so it was very harmful for investors, losing ground over that period of time. And so sometimes it's referred to as a lost decade. And I think a couple of things to look at over that period of time is that when it's talked about as being a lost decade of investing, it's oftentimes really referring to the S&P 500. And there were other markets over that period of time that actually did well relative to inflation. Small cap value stocks had a good run during that period. Commodities had a really good run. Think gold, for example, but not just gold. Other commodities did really well over that period. Real estate investment trusts, emerging markets actually did well. So with a portfolio that's diversified into some of those areas, just as an example, your return would have been a much different story. You would have given yourself the potential to have a positive real rate of return over that period. And another period of time that was a lost decade was from basically the end of 1999 to the end of 2009, that 10-year period. The S&P 500 actually lost ground before inflation. Inflation was much lower then than it was during the 70s, but the end result was a negative real rate of return. However, over that period, with diversification, there were ways to improve the outlook of the portfolio. And some of those are actually similar investments to what worked well or better in the 70s. Commodities, small cap stocks, real estate investment trusts, they also did well in that period. It was a much different market and economic situation occurring. But those areas, most likely, depending on how they were being used in a portfolio and how rebalancing occurred, most likely brought a return that was heading into positive territory versus that S&P 500 return, which was basically negative, like the only 10-year period in time where that occurred. So part of the answer, is, if we're going to head into that kind of a period over the next 10 years or, a certain period of time where the S&P 500 is negative, for example, part of the answer to that is going to be continuing diversification of the portfolio. Just think back to the couple of the slides Bill was covering with some of those returns we've seen in this really rough period, and doing the rebalancing, keeping things disciplined, and in areas of the market like, say, maybe the S&P 500 or other areas of the markets that are maybe expensive, is limiting the exposure to those areas, especially if we're going to be heading into a rough 5 to 10 year period, maybe for equities. That makes a big difference, and looking for other parts of the market that are much less expensive and making sure we have allocation and exposure there should make differences, have previously, and most likely would do so going forward. So I think it's just really staying disciplined in that period of time, but certainly recognizing the environment we're in as well.
Okay, one of the other questions is a 60-20-20 portfolio the new trend? And it's a good question. And to answer that, I'll first mention what a 60-40 portfolio is for perspective. So with most investing that we see in terms of recommendations for those, let's say, approaching retirement or in retirement, a common allocation for a portfolio would be a 60-40 portfolio allocation, which means you would have 60% of the portfolio in equities, which are more aggressive. Those are like the common equity indices such as the S&P 500, the NASDAQ, and the Dow. and then you would have the balance, the 40% in bonds or bond-like investments. So that would be like the aggregate bond index that we reviewed earlier. So that would be the more conservative piece of the portfolio. And the general idea is that it helps smooth out the overall investment returns. So there's not as much volatility that you're experiencing during a time frame where you're either getting close to retirement or maybe in retirement and starting to withdraw from the portfolio. Now, when it comes to a 60-20-20 allocation, that would likely be a portfolio that still has about 60% in equities, but then the next two numbers are changed where you would have about 20% in bonds and then 20% that would be in more commodities. So it could be a specific allocation to gold. It could be commodities as a whole, such as gold, silver, and other commodities. And now, whether or not that's a new trend, I think it's something that's, become more popular in recent years as we've seen and heard more talk about the debasement of the US dollar and in alternative currencies. And it's something that has been implemented for some time. And for example, in 2000 to 2010, that was a decade where equity performance returns over that period were relatively flat, but different asset classes such as commodities, gold, managed futures, for example, all performed well during that time frame. And we've actually been using hedge positions since that time frame, and it's something that we've been able to implement that helps smooth out the volatility and something that we've talked about on this presentation. And we actually have positions in our portfolios that range from about 22% in our more conservative portfolios for the overall equity allocation to as low as about 8% in the more aggressive portfolios that are specific to that type of hedge position that will still perform well over a longer period of time, but help reduce the overall volatility. So to answer the question, I think it is a trend that is becoming more commonly talked about, but there are a lot of principles that have been used since the early 2000s. We typically don't see it with a lot of common retirement funds, such as a target date fund, for example. Those are typically still just equity and bonds and don't have that extra 20% allocated to something like commodities or gold in particular.
And I'll just add one other point on that is that that 20% kind of alternative sleeve, if you will, that Bill was discussing, we use in terms of that we're getting that kind of exposure for our clients through exchange traded funds and mutual funds. So a key part of that is that we're using investments that don't have a lockup period, which sometimes when you hear about alternative investments, that can mean lockup periods, limited partnerships, things like that. But the way we're getting the exposure also is able to help maintain liquidity for our clients, so that we're not locking up funds for some period of time.
So we received one more question. For people who are retired and must withdraw from their investments for living expenses, who also don't have a lot of time to wait for the markets to improve, do you ever just take a significant part of a portfolio and wait things out in cash, or do you remain mostly 100% invested? Even with diversification and discipline, a portfolio can experience losses year over year, and that is especially a concern with the tail risk environment we are currently in? So it's a good question, and the approach depends on what the client's needs are. One of the important parts when investing, especially when in retirement, is making sure that you have a sufficient emergency reserve set up that helps you sleep at night. For some clients, that might be anywhere from 3 to 6 months worth of living expenses. For others, that could be up to a year, just to make sure that you have more flexibility when an environment like that were to occur. So, for example, if there was a market correction or a severe correction, that if you had cash needs, you'd still be able to support yourself, allow the portfolio to recover, and not have to change your overall way of living. And that's one of the ways that we've typically approached it, trying to make sure that our clients are well prepared prior to any event taking place.
And I think I'll just add a few more points onto that because it's a really good question. It's a key one for those that are in retirement or even not in retirement. It's all about risk tolerance. It's all about everybody's individual situation and how you react to risk. One of the tough parts is, as far as waiting things out in cash, what's that trigger point for when things are better? And that's always nobody knows that answer, and it's really challenging. And just even thinking about where the markets have been over the last almost 2 months, just call it a month and a half at this point. You have some significant downturn days, and then you have some days where the markets have had significant run-ups. And oftentimes, the biggest market one-day moves occur after the biggest one-day market drops, and it makes it so hard to time, how that's going to work out. And the markets have always been that way. It doesn't make it any easier as far as, how to kind of work through those environments as an investor. But I think Bill brings up a really good point in that, for some investors, a longer or a more higher amount of cash reserve covering maybe 12 months, could make someone feel much more comfortable in that environment. And some may even have a longer window. Maybe it's, a year and a half in cash. I think the only concern at some point is that the money in cash, hopefully getting at least money market rate of returns now, is that you're not going to be keeping up with inflation over time. But we recognize that's not always the end all be all to help an investor get through a rough market environment. Part of that, if it makes an investor feel more stable, that's also extremely important. And that longer horizon of how many months of expenses you have covered, can certainly make sense in the right situation. But the hard part has been over the last, or at least somewhat recent times, has been we've seen interest rates come back down from almost like around a 5.5% rate. And so that's where, the money, the cash reserves really would go into, would be probably a money market fund type position. But in the big scheme of things, if that is going to help an investor get through a rough period, knowing they have that kind of cushion behind them, that does make sense. You just have to consider the inflationary impact over time, that will happen with that part of your overall asset base.
All right, that looks like all of the questions that we received. Thank you, everyone, for attending. And we will turn it back over to Dan.
Great. Thank you, Bill, and thank you, Jim. A lot of great information and timely as well that you shared today. I want to thank everybody for joining us for the webcast. If you would like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment, or you can visit our website with the information that you see on the screen now. Thank you again for attending today, and this concludes the event.